Hi, my intro to small business class. We had one more assignment that would have been nice to finish, and that was 11.04, step 4, my cash flow projections. I am not going to grade that assignment. I'm not going to make you do that assignment, but it really is an important part of a business plan. So I wanted to share how to do it in case that will be helpful for you. And it will be helpful for you if you really are going to be starting your business and you're going to be starting it soon. So it's called the cash flow projection, and it's looking at more. Usually you want to do this for a full year to project your income growth. You're starting with a beginning cash flow of 0, and it's divided into 2 categories, just like we did our bookkeeping, where we have cash in and we have cash out. Cash in will be your sales projection, so the total amount of sales, and that number includes the cost of goods sold, because we figured our sales projection with that number included. And cash in will have the COGS within it. Okay, so you put that sales projection, that's your total sales, because that money is coming into the building. That is what you're counting. And then if you have other income, if a relative is giving you $1,000 to add to your business, or if you have a loan and that money is coming into the business, then you can put that extra money here. You add that together, and my total cash in for, let's say, the month of January is $20,000. That's what I am projecting for this January. This is what is really important. Now, this is the cost of goods sold. So you estimated what the cost of goods sold would be for 1 month. That number would go here. So you're doing your total sales here, which includes this number. So now you have to subtract it. And the reason we have to subtract it here is because we need to keep cash in and cash out separate. COGS is cash out. So we're going to keep all of those cash out things here together and all of the cash in here together. So we must separate out the COGS. And how you decide on the COGS is you have to determine the cost of goods sold per how many units you plan to sell. So you're going to look at your sales projection. You're going to see how many units you plan to sell. You are going to multiply that by the COGS for that unit. And then you're going to add up all of those COGS. So let's say I did that. I looked at the cost of each of the COG for each item. I multiplied by the quantity I project to sell. Okay? And then I have 10 items. I do that for each one, and then I add that total all together, and I get my monthly COGS. Let's say that cost of goods sold is $8,000. All right? Then I have payroll. Let's say I have 1 employee at full time for $2,400. Let's say I'm going to pay myself the same. That's my owner's draw or owner salary. And then let's say I'm not going to worry about taxes because I don't know what kind of profit I have yet. Rent is this, utilities, advertising, all of these are my fixed costs. These are my fixed costs that don't change much. COGS might change month to month as my inventory changes. Okay, I already paid my startup costs before I started working on my cash flow projection, so I'm not going to include that here. This is what I end up as a total for my cash out. So now for my ending cash, I must subtract the cash out from the cash in. So it's cash in minus cash out. And this is the number I get, 4,900. Okay, that number now becomes my beginning cash. And now I do everything again. Let's say I think that the second month is going to be the same as the first month. I just don't think I'm going to get a lot more customers. I know that I'm still getting the same loan amount each month to kind of boost and hold me afloat for that first year. And so I think everything is going to be the same for the second month. If I think everything is going to be the same for the second month, then I just plug in the same numbers. I end up with the same result, and I end up with the same ending cash. But now this cash gets added to my beginning cash. So now I actually begin with $9,800. These two things are going to change. I think I can go up, and I think I can make an extra $1,000 on the third month. I think I will have a stronger customer base. And so I think that I can add an extra $1,000 on my projected sales. That then needs to be, that means that my cost of goods sold will also go up. And I'm just going to pretend, okay? I don't know. Maybe it's going to go up $200, okay? Pay all of the rest is going to stay the same because it's fixed expenses. All right, so I'm spending an extra $200, but I'm making an extra $1,000, so I should have $800 more than I have here. Let's say I have $5,700. Okay, wait. I better do this first. Oop, that's not where I put it. Here. What did I say? 15,000. I know I just said what I was going to do. Okay, I'm spending to 800. So I'm going to have 15,900. So now I'm going to subtract 21,000 minus 15,900 is going to give me 800, and I really end up with the exact same thing I thought. Okay, now I take this number and I add it to this number, and that becomes my new beginning cash. And I don't have my calculator here, and that's a really bad thing. So let's do this. I know there's a 5 in there because that's 15. So what did I say? 57, 14, 15. So I think I'm not the math teacher, but I think that might be right. And if I'm not, I apologize, but you know what I mean. I am taking this number and it gets added to the previous month and it becomes my new beginning cash. I take this number, it gets added to the previous month, and then it becomes my new beginning cash. Maybe I'm going to make a little bit more money this month, I think, if I keep growing. And then my numbers are going to continue to shift if my business is going well. I'm projecting that my business is going to go well and that I'm going to continue to have better sales. My COGS are also always going to increase when my sales increase. So that number is going to come out. But these things are fixed. They should stay about the same. And I'm not going to do the math again. Like I said, I don't have my calculator handy. But that would mean I would add this up. It would be 300 more than the last time, which I actually can do. And then I would just subtract these, and that would give me this number, which I then add to this number to give me my new beginning cash flow. And then that is how, when you are presenting your company, how you can show how the profits are adding up over the course of 6 months and then a year. And then how you can also show how each month you're projecting more customers, and that's how you're reflecting your sales should be increasing here, and that your COGS are going to increase to offset that, but your COGS will always be less than your sales, or you're pricing your items incorrectly. And so you'll be able to show an upward trend of your sales and an upward trend of that beginning cash flow. you use this number here, you can put back into the business. You can put that back into the business under other costs. So if you decide at this point that you must buy some equipment, you will change this number and put a couple thousand in here, subtract it out, and lower your beginning cash flow. All right. So I wanted to share that with you because it really is an important part of the business plan. And it's an important part of projecting out what you need to make a profit and to grow your company. So I hope this was helpful. Again, you do not have to do this assignment. This is for your information. And the best of luck to you and on your cash flow projections and your future businesses.